Yeah, today is Monday, January the 5th, 2026. Happy New Year and best wishes for this new year, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. If you have ever sat in a board meeting reviewing the P&L and still felt uneasy about cash resilience, this session is for you. Today, I want to separate two concepts that are often treated as the same: profit and resilience. So, remember, the profit is practically an audit of the past, how well we've done, and resilience is what's coming next in the future. So, profit is retrospective, and resilience is the ability of a business to continue operating, investing, and meeting obligations without repeated intervention. And for the UK PLCs, resilience now carries more weight. The British Business Bank has made clear that higher interest rates and higher cost of finance are changing the market behavior, increasing pressure on survival and investment decisions. So, strategically built on closing the next deal can still show progress, but it may not be building something durable. So let's look or take a look at these three problems as follows. Number one, the UK productivity remains a structural constraint. So this is coming from the UK Office of National Statistics reports that outputs per hour in Q2 2025 was just 1.5% above 2019 levels, while nothing continued weakening in underlying productivity growth, right? So this explains why additional activity does not reliably translate into additional capacity or margin. Problem number two is that higher interest rates increase the cost of capital. The British Business Bank again states that the businesses must adapt to this environment with knock-on effects on survival, investment, and lender behavior. So, in other words, this accelerates market penalties for weak cash conversion. And problem number three, I take a live example from a listed company in the London Stock Exchange and its investor relationships page, where they state that in the financial year 24 annual report, they recognize £129,000 of revenue and describe challenges converting opportunities into transactions alongside funding pressure and material uncertainties around going concern. And this is a visible signal of a model that has not yet crystallized into repeatable assets. And what I mean by this is that running a PLC on short-term cash fixes is like relying on temporary generators. They keep the lights on, but they never stabilize the grid. And why I'm bringing this to the table? This pattern is more common than boards like to admit. So transaction-led revenues, bespoke delivery, key relationship carry disproportionate weight. Key relationship is a keyword. Is a disproportionate weight. It can look like momentum, but it behaves like fragility, right? So when conditions tighten, a single delay, a single counterparty issue, or a single funding slip exposes the structures underneath. So that is why boards need to distinguish what is activity from assets, right? And we are going to go into this now. So as a board advisor, what I will propose to consider in this case is three things. Number one, separate profitability from predictability. Boards should ask which revenues recur because processes are systemized, and systemized doesn't mean software, and which recur only because specific individuals intervene. And again, this is the UK Office for National Statistics productivity data that underlines why scale without systems stall, literally because it depends on two or three key people rather than a system that actually is a revenue machine. The second thing I would propose is designed or suggest is think about designing for a sustained higher cost of capital environment. The British Business Bank again highlights changes in how finance is priced and deployed. In other words, Weak operational models surface earlier when capital is expensive. And the third suggestion is again based on our friends, a public company listed in the London Stock Exchange, in their investor relations document as an example. They do not equate pipeline with certainty. In their financial year 24, they clarify that its pipeline is supported by letters of interest or term sheets. It's not recognized revenue and is highly concentrated with approximately 95% linked to three counterparties. So what happened in this case? My suggestion is the PLC's concentrations and conversion risk undermines the cash predictability. So this is not a criticism. It's just a diagnostic, like a doctor say, what's going on? Let me see what's going on. An asset behaves differently from an activity. Remember that activity is a different thing from an asset. And let me describe one and the other now. If revenue depends primarily on individual judgment, negotiation, or bespoke execution, it behaves like an effort, an activity. But if revenue depends on documented methods, repeatable processes, and systems that others can operate, it begins to behave like an asset because it doesn't depend on individuals. So boards that make this distinction earlier make better decisions on hiring, capital allocation, and funding structure, right? So why does this approach matter? Number one is the outcomes. Back to our investor relations document from this UK PLC. Financial year 24 disclosures provide a clear illustration of the gap between opportunity and conversion and the operational requirement to strengthen due diligence, monitoring, and reporting systems. In other words, this is a balance sheet asset formation, not a sales acceleration, right? So it's an interesting exercise there. Number two is how they differentiate. The differentiator worth emulating. If the tightening of internal definitions of progress, including changes to KPIs and pipeline reporting to reflect commitment advancement rather than headline volume, this reduces strategic self-deception, right? And number three, how they reduce the risk is adopting an asset-first discipline that withstands a higher cost of finance environment where lenders and markets respond more quickly to fragility. So the British Business Bank again explicitly links higher rates to behavioral shift in finance usage. So what should boards do with this? As an advisor, it's not a restructuring, not a strategic rewrite, it's a simple test. And one action today that you can take home is ask management to identify which revenue lines will continue to generate cash if senior leadership step back for 30 days. If the answer is very few, that is not a failure, it's a design gap. And design gaps can be addressed. So what's the next step? Stay tuned. Tomorrow, I will examine why PLCs entering the 1349 headcount stage often experience execution breakdown despite positive strategic narratives, right? So, like, comment, save this post, and join my 759 plus newsletter LinkedIn subscriber to keep receiving these and many other useful insights on how an advisory board can help your organization. And if this is relevant to you or your organization, I am happy to compare notes on advisory board design. So a short Zoom or a quick DM works. And if not, it's all good. No worry. And have a great day and see you tomorrow.